Unit 16, Real Estate Investments and Business Opportunity Brokerage. Key term review. Appreciation is an increase in the worth or value of property. Appreciation. Asset is anything of value. Asset. Balance sheet. It's for broker candidates only. Forget it. Basis is an investor's initial cost of a property. Basis. Capital gain, loss, is the difference between the adjusted basis of property and its net selling price. Capital gain, loss. Cash flow is the total amount of money generated from an investment after expenses have been paid. Cash flow. Equity is the property's value minus debt. Equity. Going concern value is the value of an established business property compared with the value of just the physical assets of a business not yet established. Going concern value. Goodwill is the intangible asset attributed to a business's reputation and the expectation of continued customer loyalty. Goodwill. Leverage is the use of borrowed funds to finance the purchase of an asset. Leverage. Liquidation analysis is the valuation method used for a business that is going out of business. Liquidation analysis. Liquidity refers to the ability to sell an investment quickly without loss of one's investment. Liquidity. Net present value, forget that, it's for the broker. REIT, or Real Estate Investment Trust, offers investors the opportunity to invest in a pool of income-producing properties under professional management. REIT. Risk is the chance of losing all or part of an investment. Risk. Tax shelter is an investment that shields income from payment of income taxes. Tax shelter. Key concepts. Investment terminology. Appreciation, assets, cash flow, equity, leverage, either positive or negative, liquidity, basis, capital gain or loss, tax shelter, REIT, and risk. Types of real estate investments: residential, commercial, industrial, agriculture, business opportunities. Types of real estate investments. Advantages of real estate as an investment: usually above average rate of return. Tax advantages: hedge against inflation, leverage of borrowed money, equity buildup. Advantages of real estate as an investment. Disadvantages of investing in real estate: lack of liquidity, it's illiquid, more localized market, expenses associated with expertise, need for active management, relatively high degree of risk. Disadvantages of investing in real estate. Risks associated with general business conditions. Business risk, or operating business risk, is the degree of variance between budgeted projected income and expenses and actual income and expenses. Business risk. Financial risk, or operating financial risk, is associated with the ability of a property to pay operating expenses from operations, borrowing, and equity. Financial risk. Purchasing power risk is related to inflation. Interest rate risk is the risk of rising interest rates. Risks that affect return. Liquidity risk is the possible loss that may be incurred if the investment has to be converted quickly into cash. Safety risk is composed of market risk and risk of default. Leverage. Leverage is the use of borrowed funds to finance the purchase of an asset. Positive leverage occurs when the benefits exceed the cost of borrowing, and negative leverage occurs if the borrowed funds cost more than they are producing. Similarities between business brokerage and real estate brokerage: sale of real property or the assignment of a lease, transfer of interest in real property, is an integral part of a business brokerage transaction. A real estate license is required to deal in business brokerage. Differences between business brokerage and real estate brokerage. Assets include personal property and goodwill. Value of real estate and value of going concern may be different. Wider geographic market for business brokerage. And that is differences between business brokerage and real estate brokerage. Expertise required in business brokerage, corporate finance, business accounting, and valuation of business. Corporate finance includes knowledge of classes and characteristics of corporate stock, securities, analysis and valuation, management of working capital, and budgeting. Business accounting, income statement analysis, balance sheet analysis, asset depreciation, and taxation. Valuation of businesses, comparable sales analysis, cost approach, income analysis, which is the best approach for valuing a business, and liquidation analysis. Steps in the sale of a business. Listing, identify all assets of the business, valuation of the business, deduct liabilities, valuation of stock, legal compliance with all pertinent laws, market and advertise the business, secure a buyer, enter into a contract with both parties, due diligence period, closing preparation, and date of closing the transaction. Basic business appraisal. Forget that, that's for the brokers. To calculate an investor's equity, current market value minus mortgage debt equals equity.